Hey folks, it's Brad with StreetAuthority, and today I want to talk to you about one of the most popular technical indicators, the Relative Strength Index, or RSI. So let's take a look. The RSI was developed by J. Wells Wilder and featured in his 1978 book, New Concepts in Technical Trading Systems. And before we dive deeper, let's just clarify something. Sometimes you might hear traders refer to relative strength or say things like, this stock has good relative strength. However, that's not what RSI indicates. The RSI does not provide information on relative performance or relative strength. It uses only the data from the security that's being analyzed. Essentially, it's a price oscillator that helps traders identify oversold or overbought conditions. And the formula looks like this. RSI stands for the average gain divided by the average loss, and the default time frame used to calculate this is 14 days, but you can kind of modify it based on your needs. The other thing to note is, you don't have to feel like you need to memorize this formula or anything. Most trading software charting platforms will already have this, but I figured I'd just go ahead and share it with you. That being said, here is the important thing you do need to know. Traders use relative strength to spot oversold market conditions and overbought market conditions. Like I said, an oversold market condition will be when RSI falls below 30. Overbought will be when RSI is above 70. And the other thing to remember is that markets can remain oversold or overbought for extended periods of time. So what traders will typically do is they'll wait for a reversal in RSI. You can also tweak the conditions for this. Some might use 80 for overbought or 20 for oversold. That matters more if you're doing a scan or something like that and you want fewer results, more tradable, actionable intel. Now let's take a look at what RSI does in action. I've got a chart here of the NASDAQ around the time of the COVID-19 sell-off in March 2020. And you can see here it delivered two overbought signals. Then later on in September, it delivered another one. The market fell about 14% in September, and obviously we had that big COVID-19 sell-off in 2020. What's important to note here is that it delivered two signals, so in case there was any doubt, it gave you a good heads up on this. It also delivered a oversold signal to get back in, which we know now with the benefit of hindsight, that was a generational buying opportunity. But it only briefly delivered that signal, so this highlights why it's wise to also rely on other indicators to use as confirmation with RSI. So let's talk about why this matters to traders. When a technical indicator like RSI is popular, it can move markets in the short term. If a large number of traders spot a divergence or an overbought, oversold signal in RSI, a quick price move could follow shortly after that. Now that could be sort of a self-fulfilling prophecy depending on how you look at it, but either way, RSI is a highly reliable indicator. It often delivers very tradable results in backtesting. So by monitoring RSI and other useful tools in conjunction with it, you could increase your odds of being on the right side of some major market moves. Now that's it for today's video. I hope you found it helpful, and as always, if you have any questions or comments, feel free to drop me a line, and don't forget to subscribe to our channel for more. Until next time.